Welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Now, the economic growth stock market mismatch we spoke about 2 weeks ago sure did take care of itself. Sprinkle in a little cold water on past employment data, add in a little bit of more dovish talk from the Fed, and you've got a recipe for a rebound. And a rebound it was, certainly one for the record books. Now, there are still three things that are top of mind. One is inflation, one is growth, and the other is productivity. Now, on the inflation front, we've spoken here about inflation being on the right path. We believe it's on the right path. On a month-to-month basis, we may get some hiccups along the way and expect that the commentators will pick apart the month-over-month data, much like a picky patron in a restaurant would if they order a medium steak and it comes out slightly medium rare or slightly medium well. They'll complain and send it back. Expect some of this going forward with the month-to-month data, for after all, it is an election year, and why waste a crisis? On the growth front, consumers represent roughly 2/3. Well, actually, almost 70% of economic growth is attributable to the consumer. And when you look at the consumer, there's three things you look at. One is earnings, one is spending, and one is savings rates. Now, for the savings rates, yes, the savings rate has dropped. In fact, it's about half the level it was pre-COVID. But at 3.5%, it's still positive, and it's just slightly below the longer-term averages of savings rates. For wages and spending, they're both positive as well. Right now, spending is slightly above wages, and it has been since 2021, but those numbers are converging. And over time, these numbers run in sync with each other. So this is to be expected. One of the things that has not received a lot of airtime has been the value or the benefit of locked-in fixed-rate mortgages at low levels. For example, if you're a homeowner and you have a mortgage, and it's at 2.5%. Right now, you can earn about 5% in a money market account, essentially creating 2.5% return out of thin air. At some point, this mortgage, which you and I would think of as a liability, becomes an asset. It certainly adds to the confidence level of the consumer and allows them to spend at a higher rate. Now, for us to look at a period similar to this in the past, we have to go back to the mid-60s, early 70s, when interest rates were rising and spending was rising also. High single digits, close to 10% a year, all during the period up to the recession of 1981, spending rates kept increasing. So that's a good thing for the consumer, a good thing for consumption. Now, productivity, which is the mechanism that allows companies to convert revenues to profits, hit an all-time low, or actually since 1947 low last summer, 2022, and rebounded sharply from there. Now, productivity and profits tend to run hand in hand. So we would expect to see, as productivity rises, profits falling in behind and rising as well. Now, there's going to be a lot of push and pull with this data month to month, quarter to quarter, and expect that. It's always a bumpy road, never as smooth as we would like. Going forward, the economy is likely stronger than we'd like to believe. The consumer likely has more staying power than many think, and companies will probably do a better job of converting revenues to profits than most think, primarily due to technology and productivity gains within the companies. As I said before, the path is never going to be as smooth as one would like, but that's the path that we're on, and that's where we start the week. Thanks for tuning in. Have a great week.